Good morning, everyone. My name is Darren Bond. I'm Farm Management Specialist out of Toulon with Manitoba Agriculture. In the interest of government efficiency, I'm your first speaker and your MC for the morning. So you're going to get lots of me, so you're such a lucky crowd this morning. It's awesome. So what I'm going to talk about today is land rents. We're going to talk a little bit about land values and how this impacts our farm, if we're a landlord, our situation as a landlord, and everything around there. Our information and all the information based in this discussion today can be found online at our Manitoba agriculture site. If you Google Manitoba agriculture production cost, you'll see production economics, and that's where a lot of this information can be found. A lot of the tools I'm going to talk about that we have. Click on cost of production, and you'll find that information quite easily. This is one of the most asked questions that I get. What is land rent going for? And it's a question that we get a lot of for a few reasons. One, unlike land sales or house sales, even equipment sales, there's no transparent market, no transaction history listings that we can go look up, we can go see and find out what local rents are going for. Often we hear the coffee shop talk, but that's just that. At the end of the day, people are very reluctant to reveal what their rents are, whether they're a producer or whether they're a landlord. The rents are highly dependent on two main things, and that is the productivity of the land and then how hot or not hot that market is in terms of competition. So when I consult with my clients, and my clients with this are both landlords and producers, I'd always tell them the only way to truly know what market rents are, if you really need to know exactly what it is to list it, that you're renting out land or looking to rent land, and then see what type of calls you get from that. That's really the only way to know. However, there are a few things that we can do to build our knowledge around this that can make us better, again, whether we're a producer or a landlord. So another reason why we're getting so much more questions and focus on the land rent discussion, and I think I've done 3 or 4 newspaper interviews on this just in the last few weeks, is renting land from a producer perspective is much easier for the cash flow, obviously. If we're looking at a rent of $70, $80, $100, over $100, whatever that number is, often that's a heck of a lot cheaper than purchasing that land with payments, principal and interest, running anywhere from $200, $300, $400 an acre and up, depending on the situation. So that's why there's a lot of attractiveness around that. That then allows producers to redirect those funds into other capital improvements if they are choosing to rent land. So it allows for some management decisions, and often these producers, I'm continually impressed by how good of management our producers are. They can effectively invest those funds elsewhere. When we purchase land, especially in the first few years when we're financing it, it is very inefficient. Again, if we're looking at a $250 an acre land payment, principal plus interest, it's very inefficient for those first few years. So we got to get through those first few years before we can really see the benefits of that purchase and the equity. Once we pay down that debt, once we see the appreciation of that land, the numbers come into a little bit better alignment, things are a little bit more favorable. But when we go back to those first few years, we're often taking the profit from our bought and paid for acres to pay for the new purchased acres. And if we're doing that, if we're taking the 1 acre that we purchased plus the 2 or 3 or how many ever acres that we own profit to pay for that one purchased acre, we can see that we can use up a lot of this money, whether it be money that we're going to use for other investment, whether it be for our own profits. We can consume a lot of this capital fairly quickly, so we've got to be aware of that. And I'll get the producers who'll say, yeah, well, they're not making any more dirt, and land has always been a good investment, and I'm not saying that that's not the case at all. But we have to be aware that in the first few years, we are at risk. And there is a trade-off between that paper equity gain and cash profit. The equity gain that we'll see as a producer often only truly helps us when we are transitioning out of the farm, selling out, or selling to the children or whoever it may be. It may help a little bit if we're able to build equity in that land, and then we're looking at some further debt leveraged expansion, whatever that may be. So there may be some advantages there, but really the advantages in the immediate are not there, and it's not there in the short term, just in the long term. So all these numbers that I'm going to start giving you, it's from our cost of production guide. Our Manitoba Agriculture booth is in the Curling Club. I encourage you to go there. These guides are free. Pick some up. They are also on the website, both in PDF and Excel. So the numbers here are based on that. The numbers are, I would say, a guide. It's the numbers that we have are not going to be the numbers on your farm. The value in this document is it allows you to, in an orderly fashion, put together your cost of productions and figure out what the cost of productions are on your farm. And that's the most important number. It's not the numbers up here, it's the numbers that are on your farm. So a quick review of some of the current situation that we see in our industry. This is crop insurance 2018 seeded acres. We can see that there are three main crops that eat up just over or just around 3/4 of the crops, and that's hard red spring wheat, canola, and soybeans. Drive around the countryside, I'm not surprising anyone when we see that. Here's our cost of production for those three crops. Again, this is some of the numbers that we have. This is a starting point for you to build your own numbers. And what we're using 80% crop insurance coverage with all of this data that we're using here. Here's our crop insurance, our cost of production cost for the top 6 crops that we have in our basket. We can see our costs are anywhere from $350 to over $500 an acre with corn. Using those numbers and average yields and some of the average pricing that we have, we can see here where our profitability lies. And what we can see is that canola and soybeans, oats and corn show some profitability with the numbers that we have in our number bank, where the wheats struggle with profitability. You know, I don't think this is a surprise to anyone. What I see with producers is the ones that make money on wheat are really great wheat producers and have some really great yields. I encourage everyone to take their number bank and do this with their own numbers to find out where they are and find out where their costs are and where their potential profitability lies. So a little bit of a look back for the last 5 years to see where we've gotten with these land rents and land values that we're seeing today. Here's our red spring wheat average yield over the last 5 years, from 2012 to 2017. What we see is that gradual increase in the yield. We've had some pretty decent years with wheat. Even in the past year, there's been dryness throughout large part of the province, and speaking to a lot of producers, they were pleasantly surprised with what they got in the bin for wheat. Canola average, again, we see this continual improvement. We've have some decent years in there over the large part. Of course, there's always areas that do have their struggles with weather. What I see is again, producers continually improving their abilities when it comes down to production, and I'm continually amazed that our management is just improving so much, and we're seeing this reflected in the canola yields. Soybeans are a little bit flatter, and again, I don't think this is a surprise considering the dryness that we've had over the past little while. But again, we've had some good years in there and some dry years in there too that have had struggles. But I would say soybeans are flat to moderately rising. And as we see these new genetics, and I'm continually impressed with the genetics that we have with our crops today, they just seem to be getting better and better and more resilient to the stresses that we have with our weather. Some prices. These prices are from our Manitoba Agriculture Statistics page. These are weekly closes, so they don't catch the interweek high. So there's going to be some prices in there where you say, oh, hey, I know that the prices was higher, I priced some or whatever the case may be. This is just capturing what we've seen with our prices in the last 5 years. And what we've seen on the wheat is for the most part pretty flat pricing. We see the big spike there in the summer of 17 with the rally in the States, but we've seen for the most part pretty flat pricing. Canola, slightly rising prices. The one thing I look at, or I pull out of that slide, is the volatility. Speaking with producers, I think back 15 years ago when a 25-cent per bushel slide was the cause for panic in the coffee rooms and stress and anxiety. Now we're seeing huge differences. And speaking with the grain buyers, a lot of use of their contracts, whether it be target pricing or whatever it may be. The volatility is something that's really taken full force, and we see it in these prices. And obviously when we look at soybeans that have over the last 5 years, so they're slightly down from the trade war that we see going on between the US and China and the impact on beans that's had. There's a lot of swings in the marketplace, and it creates a lot of risk and volatility. But again, for those producers, they're able to manage that. They can still do well in that type of a marketplace. Here's our operating costs over the last 5 years. I don't think this is a surprise to anyone that costs just continually creep up. Fertilizer is in this cost, so fertilizer is its own market, and swings within the fertilizer market can move that quite a bit. Once we get away from fertilizer, we see the slow and steady appreciation, 2 to 3% per year going up. And again, I don't think anyone's surprised when we say costs are just continually inching their way up. Machinery costs, again, I don't think that's a surprise to see our machinery costs going up. I look at that top line, which is a combine, and we look at the 2013 price, and this is sourced from Alberta Agriculture. 2013 data of around 350,000 to 5.25. And I know there's a lot of producers who tell me that they can't buy a combine for 5.25 for a new one. All things being equal, the costs have just shot up, and that's something that when we get into our rental discussion, it's something that is important for landlords to appreciate the risk and how our costs are continually rising. But whether it be parts, whether it be equipment, whether it be the service of those equipment, we have this appreciation, and it's a constant appreciation. Obviously, the dollar has a big impact on that as well with our exchange rate. This is the Manitoba minimum wage laws, not suggesting that we as producers use minimum wage, but I think what it is a good gauge to see where our labor costs are going. And surprise, surprise, we have this appreciation and this rise of labor costs. And it's difficult to attract good people. You have to pay them. And a lot of producers don't mind paying them. It just, that cost is going up and up every single year. So when we talk about land rent, I think we've got to take that step back and talk a little bit about land value. This slide here is taking our land value and looking at break-evens and profits. So essentially what this is saying is that if we're assuming we have a 75% equity stake on the farm, so we own 3/4 of our farm, a quarter of it's financed, and we're looking at doing a 20-year loan and at 5.25%, and maybe you can get lower than that or who knows what can happen in the future for that, but we're just assuming that that's what we're at. We can see where our costs are, and if we look at just strictly a break even using those 3 crops, assuming those are our 3 crops on our farm that we grow, that our break even land price that we can pay is just over $3,700 an acre, but that's farming for free. I don't ever suggest anyone does anything for free when they're in business. It's not sustainable. If we take out a $25 an acre profit out of that, we see it drop down to $2,500 an acre. And that's using our data that we have in our cost of production. What this tells me is that $25 an acre that we're taking out as profit has a big impact on the amount that we can pay for our land. And we have to be very aware of that. We're going to have some slides further highlighting that. If we take that same scenario and just take those 3 crops and put a 25 cents per bushel price down, which is not a big shock in today's market, we can see that we drop those prices from before profit $3,200 an acre to after our $25 an acre profit down to just below $2,000 an acre. That's significant, and that shows the volatility that we have, and it shows that all things being equal, we need to have that profitability and the yields and the prices in order to justify the land values that we're seeing. And that even a small shock affects how much we're able to pay for land. If we look at break-even land values between equity, so again, we're assuming a $25 per acre profit. This is a 20-year term, 5.25%. If our farm is at 75% equity, we can pay that $25.31 per acre in purchasing. But if our farm is in a stronger financial position at 85%, we can afford to pay more. We can afford to pay $4,200 plus an acre. So this is kind of the maybe the dumb statement, is that the richer you are, the more you can afford. Well, of course that's the case. But what I like to point out here is that those with equity, those that are strong financially, can afford to buy land at higher prices. And it's important to realize that they can use their financial might and go in and make a purchase and support those high land values when we're all scratching our head wondering how can we afford this, how can we justify this. Those that have the financial might, they can do it. Comes at a cost, of course. If in our cost of production guide we're using $2,950 per acre as our cost per or value per acre, of course this is wildly different wherever you go. We hear those big values, but we just wanted to peg a value for the numbers that we're using. And if we take that 20-year term, we find that our payments are about $250 an acre, principal plus interest. So we can see that it's quite significant, the amount of money that's required to service that type of a purchase. When we get up to $5,000 an acre, we're over $400 an acre. So that's something that, again, to realize how much investment is required with land. I like this slide. This is one of our sobriety slides, I like to call it. What happens if you have 2,500 acres and you want to purchase a half section? Essentially, if taking that 85% equity farm, so that strong position farm, you'll drop 10% equity by making that play in the market. 2,500 acres owned, going to buy a half section, you're at 85% equity. Doing that by financing it, you end up dropping equity 10%. What that shows me is that you only have so many plays in this land market to make. Because again, if you're at 75% and you make that play, you drop yourself 9% equity. You're in the mid 60s for equity. All of a sudden you're becoming more exposed to risk. You're more susceptible to risk. You have less ability to be able to make up ground. You have less options available to you if you start to have a couple bad years in a row. So there's only so many plays that we can make, and I think that's also held out or shown in the sales. I kind of chuckle sometimes that when we hear that land sale, that high land sale, and it's for an 80 or a quarter section, and we say that high land sale now applies to all the other land that hasn't been transacted. That's how we do things, comparable sales, and not that that's a bad way of doing that, but that assumes a few things, and those few things are that there's a limited supply of land that's coming up. It's also that there are the same amount of buyers there. If we start to see changes, negative changes in that, more land coming up, less buyers in the market, obviously that's going to impact things quite a bit with our land. So it's important to have that understanding, is that we are in, I would say, a delicate balance when it comes to land, and we've always seen this land go up. This is the FCC Farmland Annual Values Report. This is for Manitoba as a whole. We can see that we've had some significant gains over the last 5 years. And that we're in excess of 75% since 2012 of appreciation. So obviously it's a good thing that land is going up. It shows that it's a healthy economy. But we all are also seeing that we're now starting to flatten out for appreciation. 2017 was, I think, 5.1% for Manitoba as a whole. So we start to see is that when we get a superheated land appreciation, it starts to come back down to earth. And again, we have to just be aware of where we are with our farm, where we are with how strong we are financially, where our risks are when we start thinking about these land purchase decisions. So usually by this time, I'm told, well, you know what, Darren, you know what, good points. You're a heck of a government worker, you've talked a lot and haven't told me anything about land rents. And that's true. I wanted to make sure that everyone has the framing around the land rent discussion and understanding where these land values what they've done and the impact that they've had on our farm, because that leads us into this land rent discussion. So obviously the market dictates what land rents are, and obviously land productivity has a big influence on what land rents are. But essentially there are a couple ways that we can go use on our own farm, or if you're a landlord, be able to determine some numbers that can help us out. And we have two methods that I think are valuable. One is the production cost method. Essentially looks at the revenue and the costing and comes down with what you can pay. And the last one is the land value method, that we can look at land values and look at returns and see what land rents could be. So the production cost method is fairly straightforward and fairly simple. And if you have your cost of production data, it's really easy to do. Essentially, we're going to look and take our grain yield and grain price, come up with a gross revenue, and we're going to take away our operating costs, our labor costs, equipment costs, and storage costs, and we come up with a number at the end of the day. And then I always suggest is that, of course, we're not doing this for free. We're business people. We're doing this for a return, and we may love what we're doing, and that's great, but we still also have to make it viable and have to see a return. So we always want to put a producer profit expectation in there to make sure that we're capturing everything. So keeping in mind that yields for the most part are increasing, prices are flat to slightly increasing, operating costs of production are generally 2 to 3% higher, labor, machinery going up, flat margins. That's why we're seeing this huge expansion amongst these farms, because of these flat margins. Farms have looked at one way to increase revenue through expansion. So how do we help you with this? Well, thankfully, I'm with the government and I'm here to help you. So we do have a tool within our Manitoba Agriculture resources that we can help you with, and it's called Rent Plan. It's pretty simple. It comes up with this gross revenue, takes away this these costs, takes away your profit expectations, and comes up with a maximum rental amount that you can pay on your farm. That's a copy of the resource there. They're both online and in our booth at the Curling Club at the Manitoba Agriculture booth, so please pick one up. This is what it looks like on the Excel spreadsheet. It's a pretty neat little tool. We can take the different crops that we grow. So on our farm, we say we have 3 crops that we have in our rotation: canola, hard red spring wheat, and soybeans. We can put in the acres, because that's a challenge, right? When we rent land, we're not renting land just to put wheat on it every single year. We're introducing that land into our rotation if we're renting it beyond 1 year. So we need to make sure that we capture the complete picture of that matrix and that rotation to make sure that we capture the profits from each of those years. And we want to weight average it to make sure that we're comparing apples with apples. We come up with a probable yield and price, and I always caution both producers and landlords to be realistic on that, because we'll see how sensitive this can be with some changes. So we come up with our operating costs and our returns. So in this case, our weighted average using those numbers are about $400 an acre of gross revenue. We take out our operating costs, labor, equipment, storage, and we come up with a maximum that we can pay before profit. And using these numbers, we're at $82, just over $82 an acre. And we got to take out our producer profit. This is a number. We're not suggesting that this is what the number is. What we're suggesting is you need to put your own number in here that you feel comfortable with to make sure that you're capturing it. We're saying $15 to $30 for a starting point, and that leads us to the amount that we can pay making a profit of somewhere between $52 and $67 an acre. In this example, saying 60. And I know there's a lot of producers say, I'd love to rent $60 an acre land, and there's others that are saying, well, $60 will buy me half an acre. And that's fine, but the important part here is to figure out these numbers on your farm. And you might find that some of your land actually have great returns, and some might be a little bit sobering as well for your returns. This way has a lot of strengths. It's a clear and easy way to figure out what you, as a producer, can pay for rent. And that's hugely important. It allows you to measure that profitability that you have on that rented ground. It does make it incredibly hard to lie to yourself about where your profitability lies. And the other thing that I'm seeing with this, it gives landlords the appreciation for what producers are going through in terms of how much they have to invest, how much risk is there, and what those margins are. A quick note on landlords. Landlords today, I find, are a little bit more separated from the farm than what they were years ago. Years ago, it was the retiring farmer that was the landlord, so he would retire, sell the equipment, rent out his land. He had a good understanding of where land rents were, the challenges that went into farming. So there is that appreciation and a better connection. So what we're starting to see more now, and this is something that has been going on in the States for a little while, is that there is one generation removed landlord. And this has created some challenges. And it's not that it's a bad thing, because most of the landlords, in fact, the overwhelming majority of the landlords I talk to, really want to work with their producer tenant, and they really want to see them have success, and they really want to have a beneficial relationship, and they're willing to leave a few dollars on the table, they're willing to be flexible, whatever the case may be, to make sure that there's a good connection there. But it is something that the landlords today don't appreciate, is the risks and the costs and the sheer capital that's required for farming and producers. So this is almost a bit of a side benefit that we've seen with Rent Plan. There are limitations with everything. There's limitations. Obviously, market influences are not captured in this. The producer profit expectation is ambiguous, and it's hard to define, and it's different things for different people. It might be a lot higher, it might be lower, it all depends on the situation. But I think it is important to consider what you're comfortable with. And it is highly sensitive to the yield and price fluctuations. We're going to take a look at that next. So we need to make sure that we are realistic in this, and that is a challenge if we're starting to look out, signing a 5-year contract. Who knows what we're going to see in year 5? So that's why we need to make sure that we're realistic and we know what we're getting into. So if we look at knocking down the price, we're not knocking it down a whole lot, but 25, 50 cents a bushel, we can see that we were at $60 average an acre that we can pay for land rent. With that previous calculation, we're now down to $43 an acre. A relatively small change, something that might happen in the marketplace in one day on all 3 crops, we can see that it has a big effect. On the flip side, if we start looking at prices being high and we start to get overly bullish and unrealistically optimistic about prices, we can also lie to ourselves about how much we can pay. So that's why it's very important to have that realistic view and understand that as we see the yield and price move, we can see some changes within what we can pay. The next method that we have is the land value-based method. So some of the factors at play there: land values on the rise. Again, that's not surprising to anyone, but it is becoming a focal point for landlords because they're aware of this, so they know that, well, if land values rise, maybe the rent should rise as well. We have an investment rate in there. We want to make sure that we're comparing apples with this investment rate that we're going to use with this calculation coming up. Land is very low risk. There's a lot of benefits to owning land. So we want to make sure that we're reasonable in that investment rate. And finally, property taxes. We don't want to ignore property taxes. We want to make sure that we understand what they are. And this may bring a chuckle, but there's a lot of people who don't understand how much they're paying on a per acre base on property taxes. They know it's gone up. They know it's enough. But we want to make sure that we know exactly what we're getting on that end. A very simple calculation. We're using that $2,950 per acre value for land in our example. We're using 1.5% to 2% for an investment rate, taking away, in this example, $15 an acre for property taxes. We end up coming up with $59 to $74 per acre for land rent using this method. Speaking with producers, a lot of them feel that 2%, 2.25% is kind of what they've seen. But it all depends on markets and how hot or cool the market is. So it's a pretty easy way to figure it out. Landlords like this way of looking at land rents because it's something that they can understand. If you know your land value, you know what type of investment rate and property taxes you're paying, you can figure something out pretty easily. So they can look at this and start to compare some of their investments that they have, because again, they're not in the business of farming. They're a landlord. They're needing to see the return for the investment and the equity and value that they have tied up. There are some limitations. What is land value? We think that that's an easy number to determine, but if there's not a lot of market sales in your area, you're not willing to pay a real estate or an appraiser to come out and determine what values are, it's not always easy to come up with that value, and we might have a range for that. We also have to be aware that there are non-ag influences on land. I myself, we own some land just outside of town, and it has a subdivision potential for it, so it's probably 50 to 75% higher than land just a mile away that has the same productive capacity. And I wouldn't be unreasonable to think that, well, because of that, I should get paid more on my ag rent. So we just have to be aware of that to make sure that we're, again, comparing apples with apples. And the investment rate, again, we want to make sure that we use a similarly quality investment rate to make sure, again, we're capturing things properly. So one of the things, though, is that as a landlord, there's more than just the cash rent that's at play. There's also that appreciation. We talked about it some slides ago about some of the appreciation values that we've seen. If we use a 6.3% average for land appreciation, and we're going to take our $60 an acre rent and we combine that, the cash profit and the equity gain, we can see that there's, in this case, just over an 8% return to a landlord. So that's why we're seeing a lot of people retain their land and enter into these rental agreements, because there is definitely value for them with that. I want to say a few quick words on flex lease. I have a lot of producers who will tell me, well, I'm in a crop share. Depending on what the price is, depending on what the yields are, the farmer splits it with me and he writes me a check at the end of the day and gives me a check, and I'm in a crop share. And I'm like, well, I don't think that's a crop share. That sounds more to me to be a flex lease. We are seeing this with the amount of capital that's required for farms today. And it allows people to jointly benefit in the good, and then in the bad allows people to share those losses. So we're starting to see more and more use it. And we have this in our rent plan. It's pretty easy to come up with. We come up with our probable yield, our probable price, and we can put a floor and a ceiling price or range on that. In this example, we're using 80 to 120%. So we come up with $48 to $71 is the range that we have that we're going to use. We then, in the top red circle, put in what our actual yield is, our actual price that we're going to use for this example. And with rent plan, it does the math for you and it comes up with what the value is. And in this example, using those values, we're seeing that we're ending up on the top end of the spectrum at $70 per acre. So it's actually a pretty easy way to figure it out with the tool that we have. We can see that we have some analysis that we can compare the different ranges, the ceiling and the floors that we have, and we can, both from the producer and the landlord, see what our returns are. But one thing I want to make sure that people understand with flex agreements is that there's a trust and communication required for these. Not every agreement is going to be this. We have to make sure that we understand that there's two sides to this. We have to work together. It can be very complicated if we start flexing more than one or two items. And we also have to make sure that we're able to agree on how we're going to determine what the yield is, what the price is. Because when you actually get down to it, it gets to be a little bit more difficult to actually say, okay, well, how are we actually going to do this in a way that both sides are happy with? Some other considerations that I always talk to both producers and to landlords: when is the rent payment made? Is it 100% spring, 100% fall, 50% spring, fall? Because that's going to impact risk, that's going to impact time value of money, and that's going to impact the rental rate that you're paying. Another thing, especially with soybeans coming into the rotation big time over the last few years, is what's the nutrient bank that you have in that soil starting and ending. We're starting to see beans suck the phos out of the soil, so we want to make sure that both as a landlord and as a producer, that we're not having that be a silent cost on these rental agreements. I always think that, you know what, you deal with the best producer, the best landlord, you're going to get the best returns overall in the long run. And that leads to that sleep at night factor. That's, I think at the end of the day, if you're profitable, you're content, and you're able to operate, I think that's the name of the game. A few points on characteristics of good rental agreements. Obviously, honesty, cooperation. To maximize long-term profit, it's about being fair to both sides. I always suggest written agreements, not so much that you're going to take someone to court or anything like that, but what the process does is it clearly outlines the expectations and responsibilities and milestone dates and numbers within the rental agreement so that both parties are aware of it. There should be some flexibility just in case there's something unforeseen that happens. And it should be tailored to each individual needs. And that's something that I think it's good rental agreements can easily accomplish. And we got to make sure that that lease period is long enough to let the producer take those good farming practices. Is something that I'm always suggesting to landlords, to make sure that they understand that, because if we don't have that, they'll have a less marketable asset in the future. So it's in everyone's benefit. I have a colleague that would tell me, okay, Darren, that's nice. I just was on my phone for the last 40 some odd minutes of your presentation. You got one slide to tell me what I need to know about land rents and land values. Well, so here you go. The market determines what land rents are, obviously. Great relationships will lead to best profitability on either side of the landlord-producer relationship. Losing money on rented ground is just losing money. You lose money on purchase ground, it is blunted by the land appreciation, which is great as long as you don't go bankrupt in those first 5 years. Renting ground can drive down your fixed equipment costs on a per acre basis, but that's going to assume that you are over-equipped to begin with or going into that agreement. We do have a number of resources. We do have sample agreements on the web. They are in Word, so they can be downloaded and you can use them and tailor them to your situation. We do have Rent Plan, and we do have our Farm Machinery Custom Rental Rate Guide at the booth and online, so make sure you pick that up. And we got 1 minute for questions. If there's any questions, I can answer it, and if not, I am going to be around and up at the back all day long, and I will be at our Manitoba Agriculture booth at the Curling Club this afternoon, and I will be there from 3 to 4 answering questions specifically on land rents and land values. Is there any quick questions? So with that, I'd like to say thank you. I appreciate you all coming out and hearing what we've had to say on land rents and land values. And we are going to get our next speaker up here, Lance, right away here. So we're just going to get him set up and we'll hand it over to Lance. Thank you, everyone.